Hey, what's up, stock compounders? Brad here. So I just saw the annual meeting from Matthew Peterson. Okay, Matthew Peterson runs Peterson Capital Management. A lot of you probably know of Matthew Peterson from the work he's done on Daily Journal. He's done some pretty in-depth analysis of Daily Journal, which I've referenced in the past. He also talked a lot about that on the podcast with Tobias Carlisle of the Acquirer's Multiple fame. But just yesterday, Matt Peterson released the annual meeting, a recording of the annual meeting. It's like 33 minutes of him talking, and then there's like an hour Q&A. And I just wanted to share some highlights about Seritage Growth Properties, okay? One of the main positions for Peterson Capital Management is Seritage Growth Properties. I think it's one of like 6 core positions. And Matt has a really interesting strategy for buying into these companies that he wants to own, selling cash secured puts, okay? And so first I'm going to share his investment thesis for Seritage Growth Properties. And then I'm just going to talk through a little bit about what they've been able to get for those puts that they've been selling. So firstly, Seritage, here's the investment case. So effectively, there are 3 different buckets. In terms of the properties owned by Seritage, there's 3 different buckets that those fit into for the purpose of this valuation. The first one is properties that are developed that have paying tenants. Okay, they're kind of ready properties currently generating income from tenants. So with those properties, the current net operating income is $91 million. Okay, $91 million annual NOI. So based on a 7 cap, okay, and this is quite conservative. Typically, the industry is using around a 5 cap for these kinds of properties. But assuming a 7 cap, and what you do there is you just take 91 million divided by 0.07, okay, to get the property value, or in this case, the value of this basket of properties, 1.3 billion. Okay, that's sort of the value that he came up with for this first basket of properties. The second one, projects that are underway. Okay, now there's 2 buckets within projects underway. The first one is these signed but not open leases. Okay, if you guys have read any of the reports, the annual report or the releases for Seritage, you'll see a line that says SNO leases. Okay, SNO, S-N-O, signed, not open. So this is expected to be generated within the next 12 months, okay? This net operating income from the signed but not open leases, $65 million. The future leases, this is expected to be realized within 3 years, okay, within 36 months. So there's within the next year, and then there's within the next 3 years. So I guess this is within the next 1 to 3 years in that range, 50 million in NOI from these future leases. So if we add those up using the same 7% cap rate, we've got a combined value of $1.65 billion. Okay. The third bucket is non-core assets. Okay, these are assets that may be liquidated, properties that may just be sold off to raise cash to put into the development projects. Possibly, there are also going to be future development projects. Okay, these locations, these sites that they own. So if we value these at a conservative $70 per square foot, you've got a value of $1 billion. Okay, 15 million square feet, $70 per square foot. So if we add all that up, the value of the properties is, what is it? It's about 3.9, just shy of 4 billion. Okay. Now we do a little math here with the balance sheet. We've got 100 million in cash, subtract out 1.7 billion in debt, and then we're going to also subtract out the estimated 3-year cash spend and project capital expenditures of 800 million. All right. We're also going to add this. They have some joint venture properties that they own with other entities. So Matt Peterson is assuming those multifamily apartments that are owned jointly have a value of about $450 million. Okay. And then there's no value being placed on the raw land that's owned by Seritage. So if we do all the math, we've got 3.9 billion in property. We're going to add 100 million in cash, take out the debt, take out the project capex, add the JV. You've got just shy of 2 billion to equity, okay, to the equity holders. That's sort of what's left over. With 56 million shares, okay, that's the current shares outstanding, plus the OP units, the operating partnership units. If we divide that value to equity by those shares outstanding, we get $35 per share, okay, by the year 2025, when these future value leases are realized, fully realized, $35 per share, okay? So right now it's 14, right on the money. As of August 19th, Seritage is trading at $14 per share. So to go from 14 per share today to 35 per share in the year 2025, that's a 26% rate of return, okay, annual rate of return. So that is the sweet spot, right? That's the Monish Pabrai compound 26 license plate right there. So that's pretty exciting. Again, this is the valuation work that was done by Matt Peterson. Now, the next slide, he talks about how Peterson Capital Management actually is buying into this opportunity. All right. You've got a target SRG share price of 15. So the put options that they're selling have an exercise price of $15 per share. Okay. Now, the money they make by selling these puts that expire in January 2023 is $4.50. Okay. That's per share. That's incredible. So there's two scenarios here. One is, the price drops below 15, okay, and they're put the shares by, this counterparty. If that happens, their effective cost is $10.50 per share. All right, that's beautiful. If you're paying $10.50 for something that's going to be $35 per share in 2025, that is a great situation. The other scenario is that the price doesn't drop below $15 per share. Of course, it has already dropped below 15. So I'm curious, how many shares they've already been put in the last couple of days. But, say none of those are put to them. Now they're making $4.50 per share from the premium, where they've put up $10.50 of collateral. Okay. So that's a 42% return over 17 months. All right. 17 months is the duration of those puts that they've written, which is 28% annualized. Okay, and they don't even own anything. They're just getting that 28% annualized rate of return simply from the premiums that they're collecting on these contracts. So pretty remarkable that they're able to earn that kind of money writing these puts on Seritage Growth Properties. So that's most of it. I just wanted to share, there's also a Q&A. I'm going to link both to this presentation, which is, like I said, about 33 minutes. Highly recommend everyone watch this. It's fantastic. And I'll also link, there's a piece in the Q&A where Matt Peterson expands a little bit on Seritage Growth Properties. I think it's just like 7 minutes. But I'm just going to share a few points from that. Matt was asked about the pandemic and the impact on, companies like Seritage, the properties they own with all of these retail clients. The shift away from retail or this, situation that we're currently in with retail and office, where, there's a lot of people staying home, working from home, not necessarily going to these retail establishments. This whole thing is why this opportunity exists, okay? And Matt Peterson expects that we're going to get back to normal, at least close to normal, soon-ish. Okay, I don't think he laid out exactly when that might happen. Obviously, with what's happening with the Delta variant and all of this, there's a lot of uncertainty, right? There's a lot of uncertainty in the system, and that's part of why this opportunity exists to buy or to sell puts with this kind of situation on a company that Peterson thinks is going to be worth $35 per share in just a few years from now. So that's why it exists. He talks a little bit about the debt and how when he started digging into the terms of the debt, right, the documentation of the debt, it quickly got very confusing. It was over, Matt Peterson said. So he brought in Danielle Town, who was kind of the one who was moderating this annual meeting, which was kind of interesting. And Danielle Town, she has a law degree. She went through and combed these documents that laid out all of the debt terms. And what she found is, the covenants were very light. There were all sorts of things in this debt documentation that were deeply embedded, resembling a joint venture type relationship between Berkshire Hathaway and the equity holders. So, the kind of underlying ethos of Berkshire Hathaway in this is they're seeing it as a partnership, not a situation where, the moment Seritage isn't able to pay the interest owed on the debt, they're just going to strip all of the assets, right? That's not, doesn't seem to be the situation here. And obviously, based on what's happened since the pandemic with the terms from Berkshire Hathaway, there has been flexibility there. So that was encouraging to Matt Peterson. He spent a lot of time digging into each individual property owned by Seritage and came up with somewhere around a $4 billion liquidation value. Okay, if all of the properties had to be sold in a fire sale, he thinks they could probably generate about $4 billion from those sales. So, you look at the debt and how that compares with the liquidation value. That's something about what Tom and I presented back in 2020 when we first did our joint collab on Seritage Growth Properties. Densification. So one of the big potential value drivers with Seritage Growth Properties is the opportunity for densification. All right. So Sears, if you think of a Sears store, I don't know how many of you watching this have ever been to a Sears store, but it's a big box, usually at the end of a mall, and it's one story. Okay. It's this one story massive building. It's like a warehouse. Now, a lot of these old Sears locations are being, redeveloped into multifamily and mixed use type properties. So, that brings it from one story to potentially building up to a 5-story, a 10-story, sort of multifamily on top, mixed use retail on the bottom. So you can't look at the current square footage necessarily to figure out the full potential of the value of these properties within Seritage, because there's that opportunity to multiply the square footage by building up from 1 story to multiple stories. And that's not built into any of these numbers that Matt Peterson laid out in the previous slide. So, it's really giving me cause here to think more about selling puts and doing that strategically. One of the things I really enjoyed about this presentation is when Matt Peterson looks for new opportunities, new stocks to buy into, the top of the funnel is the 13 Fs, okay? They're following about 100 different fund managers, long-term value fund managers, in order to get from 10,000 stocks, right, the whole universe of stocks, say in North America, down to a couple hundred stocks, okay, stuff that's been bought recently by these super investors, these great investors through the 13F filings. So I really resonate with that approach, something I've been doing mainly with Monish Pabrai. You look at my portfolio, it's, most of what I own is owned by Monish Pabrai. And clearly Matt Peterson is doing the same with Daily Journal. Guy Spear just bought Daily Journal, obviously. Charlie Munger is sort of the head of Daily Journal. And Naspers, it looks like Peterson Capital Management bought into recently. There's also a Q&A snippet about Naspers and Tencent, which I found very interesting. So anyway, guys, really enjoyed this presentation. Check it out. I will link to both the full presentation and the Q&A snippet on Seritage. But yeah, just awesome stuff from Matthew Peterson. Big shout out to him. And that's all I got for this round. All right, guys, I will see you all in the next video. Take care.